The death of discovery. In the last video, we followed money from seashells, to coins, to gold bars locked inside stone vaults. Back then, wealth was something you could stumble upon. A man could walk into a mountain poor and walk out powerful. Gold meant food. Gold meant land. Gold meant armies obeyed you. Wealth was discovered. That world is gone. Today, if gold sleeps under a mountain, it already belongs to someone. Not the man who finds it, but the system that claims it. The land is registered. The minerals are licensed. The discovery is regulated. We don't find wealth anymore. We measure it, record it, authorize it. We calculate it. The Great Decoupling, 1971. After the World Wars, something broke. Countries were trading ships full of grain, oil, steel, and machines. But settling those trades with gold became absurd, heavy, slow, dangerous, limited. So they built a shortcut, paper, a promise that said, this note equals gold in a vault, the gold standard. For a while, the illusion worked, but the world kept growing, and gold did not. The United States printed more dollars than its gold could support. Other countries noticed. They came asking to convert paper back into metal, and the vaults could not answer. In 1971, the 37th U.S. President, Richard Nixon, made the truth official. Gold was removed, money was set free from metal, and for the first time in history, value was no longer backed by gold. Only law, force, taxation, and trust. Modern money is not a thing. It is a political agreement, a global trust me note. And every second of every day, that trust is priced in one place, the Interbank Market. The scoreboard of nations. You see it in the numbers. $1 equals 3.67 dirhams of Dubai, or 90 Indian rupees, or 7 Chinese yuan. It looks arbitrary. It isn't. It is a live scoreboard of national strength. But here's the part no one tells you. That number, 3.67 dirhams for $1, was not guessed. It was engineered. In the 1970s, when gold died, countries needed a new anchor. For the Gulf states, the anchor became oil. Oil was sold in dollars. Their economies earned dollars. Their reserves were dollars. Their imports were priced in dollars. So the UAE made a decision. We will lock our currency to the dollar. Not by belief, by force. Their central bank promised, we will always exchange 3.67 dirhams for $1. To keep that promise, they did three things. They stored massive dollar reserves. They controlled how many dirhams were printed. And they intervened in markets whenever the price tried to move. That is called a currency peg. Not magic. Maintenance. Other countries chose a different path. Europe let the euro float. Japan let the yen float. India lets the rupee float. Their prices are not fixed. They are auctioned, every second, by the world. When investors buy a country's bonds, euro currency rises. When factories export more, euro currency rises. When money is printed, currency falls. When war starts, currency falls. When interest rates increase, currency rises. No meeting. No global vote, just billions of transactions colliding. That collision is the price. Imagine every country as a company. Some sell oil, some sell technology, some sell labor. If the world wants what you sell, it must buy your currency first. When America buys electronics from China, it pays in dollars, but Chinese workers eat in yuan. So somewhere in the middle, a massive bank sells dollars and buys yuan, at a scale large enough to bend charts. That pressure becomes price. Trade creates currencies. Speculators merely watch. Above this river stand the central banks. They do not gamble. They redesign gravity. They decide how expensive money should be. They print. They burn. They intervene. One signature from them outweighs 1 million retail traders. They do not play the game. They write the rules. The nervous system, swift and settlement. Below the politicians flows the real market. No building, no headquarters, just a web of banks. JP Morgan, Citi, HSBC, Deutsche Bank, Barclays. Transaction sizes, $10 million, $100 million, $1 billion. Platforms, EBS, Reuters, matching. This is where prices form. Everything else is a derivative. They don't click buy. They transfer ownership of capital between nations. They use a private nervous system called SWIFT, messages flying across continents. Send this, receive that, confirm. Then comes settlement, the final boss. The moment money actually moves from one central bank ledger to another. Until that moment, everything is just numbers on glass. Settlement is reality. There is no central office for Forex. It's just a giant web of banks providing liquidity. Liquidity is just a fancy word for, do you have enough cash right now to handle this trade? If a country runs out of liquidity, the system breaks. Liquidity is the blood, not candles on a chart. Real reserves. If the blood stops flowing, the body collapses. If liquidity dries up, factories stop, imports die, and governments panic. Let's make it even more real. Take the United States and Japan. Every year, Japan sells cars, robotics, precision machines, electronics. That brings dollars into Japan. But Japan buys oil, natural gas, military equipment, software, aircraft, all priced in dollars. So two rivers move at the same time. One river of dollars flowing into Japan from exports, another river of dollars flowing out to pay for energy and defense. Japanese companies receive dollars. They go to banks. They sell those dollars and buy yen to pay workers. American importers need yen. They go to banks. They sell dollars and buy yen. Millions of these exchanges, every day. No meeting, no committee. If more dollars enter Japan than leave, the yen strengthens. If more dollars leave Japan than enter, the yen weakens. That imbalance becomes the price you see on the screen. Not politics, flow. Goods move one way, currency moves the other. The exchange rate is the footprint of that movement. The molecule and the elephant. And you? Where are you in this machine? You are not in the river. You are not in the banks. You are not in the settlement rooms. You are watching shadows on a wall. When you trade on your phone, no currency moves. No SWIFT message is sent. No central bank records anything. You sign a contract with your broker, a bet, a simulation. The banks move money to buy the world. You guess the direction afterward. They trade for survival. You trade for hope. You are a molecule riding on the back of an elephant. The elephant does not know you exist. And if it shifts its weight, you disappear. So why turn this cold, institutional machine into a colorful app? Why promise ordinary people they can outthink nations? Because the structure allows something beautiful for them and destructive for you. In the next video, I will show you the retail trap. Not opinions, not motivation. The mathematics of why most accounts die. I'll see you there.